Josh. So,
Hello, fellow rebel capitalists. I hope you are well. We are back with the real estate expert himself,
Jason
my good buddy,
Hartman.
Jason Hartman. That's right. So we've been talking about negative real rates in the last few live streams we've done, the last couple here, over the last maybe 2 hours. And so I wanted to go into a chart of the rates of inflation in the United States going back to the early 1900s.
Yeah.
Because that's really a part of the real estate investing game right now, because of the fact that you can get a 30-year fixed rate mortgage.
Yeah.
And both you and I have been saying that you need to look at the balance sheet a little bit different, from the standpoint that the property, in my opinion, is now the liability in a lot of markets because the prices are so high. But if you're securing that with a 30-year fixed rate loan, then that is actually the balance sheet, the asset on the balance sheet. And that's really tough for people to get their head around. But I think if we look at this chart and kind of explain it, it'll make sense for everyone watching.
Very few people understand that a mortgage, what a banker would call a liability, well, it's an asset to them, but you know what I mean. What a banker looking at your balance sheet would call a liability can actually be an asset, because the money being so cheap, literally getting paid to borrow, is a huge asset. I mean, the money doesn't need maintenance and repairs, and it doesn't have tenants to manage.
Yeah, right.
The property does, right?
Yeah.
So that's a big part of it. Yeah.
Yeah, and how you're doing that, how there's a transfer of wealth, or how you increase your purchasing power by actually having this 30-year fixed rate debt, is you're paying it back with cheaper dollars. So, I mean, you could just take it to an extreme so people really understand. So if you took out a loan right now for $100,000, let's say you didn't have to pay it one payment, and you just made a balloon payment in 10 years.
Yeah.
No interest, $100,000. Well, let's just say that we go through hyperinflation, and at the end of the 10-year term, you basically have a free house, but yet that house can buy the same amount of goods and services in 10 years as it does today. And that would be a transfer of wealth or purchasing power from the lender to you, the borrower.
Right.
So let's go back and look at this chart. And the reason I think it's important.
All-nighter hiders there.
Here we go. So this is the time frame that most people think of when we talk about inflation in the United States. We got the 1970s.
Yeah, so your mouse is pretty small there, right? So you've got the 70s and just follow George's mouse.
Yeah, so 70 here, it spikes up to over 12% in 73, 74-ish, and then goes down, but it still only went down to 6% and spiked back up to almost 14%, call it 79 or so. So this is the decade of inflation. But what most people don't realize is we had just as much, if not periods, where we had higher rates of inflation during the 1940s. And I think why this is so much more applicable today, potentially, than the 1970s, is because this is a time in the United States where we had financial repression, meaning the Fed came in and they pegged the long end of the yield curve control, something that we hear in the news, at least with the rebel capitalists that follow macro. They hear this in the news all the time. The Fed governors have talked about this, such as Lael Brainerd. She said that we should consider doing yield curve control. I would argue that they're already doing it, because the Fed is buying so many bonds or treasuries at the long end of the curve that's artificially suppressing interest rates. And therefore, the rate of inflation, especially the real rates of inflation, are far higher than the interest rate or the yield on a 10-year or 30-year bond.
Absolutely.
So I think that will be the 2020s will most likely be a decade of financial repression, just like the 1940s. So I think as people who, maybe you're a real estate investor or someone who even owns a home and you have a mortgage, you have to understand how that would have worked out in the 1940s, so you can position yourself to take advantage of that if you're someone that believes we will have that financial repression in the 2020s. Right?
So are you saying, George, that we don't already have financial repression now?
No, we do.
Oh, okay.
Yeah, I think we do.
Want to make that clear,
but I think that we're going to have it into the indefinite future. I think
quite
that
a while.
The 2020s will be a decade of financial repression, just like the 1940s was. And I just wanted to pull up this chart of the 1940s because I think the dynamics are even more similar to today than maybe the 1970s. And I think most people don't realize how extensive inflation was during the 1940s, because when we hear the word inflation, we just think the 1970s.
So, what is the causal issue back to the 40s? I mean, was it ending the war and baby boomers coming home? And the U.S. had the only industrial capacity in really the entire
And that
world,
massive money supply
right?
creation.
Yeah.
You had massive money printing.
So, yeah, tell us about that.
Because you had to go at the gold standard to pay
Right.
for the war. So
Yep.
then after you come off, or you're done with the war,
Yep.
you still have all those dollar bills that are floating around the economy chasing goods and services.
Right. And we had Bretton Woods. Okay, they had the big
1944,
conference,
right?
yeah, in New Hampshire about a year before the war ended, I think. And so what decision was made that caused this? I mean, it was just they didn't stop the printing press fast enough, or what caused that
We
inflation?
had so many additional dollars
Yep.
that were circulating within the economy on
Yep.
the balance sheets of the non-bank entities
Okay.
and the real economy. And then you have all the soldiers come back, which then demand goes up. You have all these additional dollars,
Right.
but you have less supply of goods and services
Right.
because everyone's been overseas shooting people
Instead of building things.
Exactly.
Yeah.
Instead of creating goods and
Right.
services.
Yeah.
So then you have this inflation, but instead of allowing rates to actually go up,
Right.
the Fed kept interest rates artificially low.
So it set the economy on fire.
Yeah, which is what gave you these extremely high rates of inflation. And what's really irritating is that during the early 1940s, during World War II, the big push with the government is to try to get everyone to buy war bonds.
Right. I remember the posters. I've seen them.
Yeah, that's right.
Well, I mean, I didn't see them in
that
person.
was like your patriotic duty
Yeah, right.
to buy war bonds. And as soon as the war gets over, they completely inflate away the debt, basically. So they're robbing purchasing power from all those people that bought the war bonds. They got screwed.
Right.
So the government basically stole that purchasing power from all those people that bought the war bonds to pay for their war and their profligate spending.
Yeah, what a scam. I just wonder, had we not had a centrally planned economy, right? If we didn't have a Fed back then, and the market set the rate for money, and it was just a free market, right? Which is how I would like to see it. What would have happened? Would the market have adjusted that out and prevented these spikes?
That's right. Because interest rates would have gone up.
And what's so interesting is that was the Fed's mandate. That was their original promise, that they would even out these spikes in the economy. And look at the chart.
Yeah.
Have they done that? Not even close.
Yeah. In fact, just look at a chart of inflation or the devaluation of the dollar since 1913.
Oh, it's like 3 cents now.
Yeah. And so it's pretty much, it goes straight down.
Yeah.
You know, if you look at there's some bumps along the way,
yeah.
but it's pretty much straight down since 1913
Right.
or prior to 1913. You see the dollar, as far as the value of the dollar, stay very, very consistent.
Yeah.
With the exception of the Civil War.
Yeah. Yeah. It's a scam.
Yeah. So if someone believes that we're going to go into financial repression in the 2020s, or we're going to see it throughout the whole decade like we did in the 1940s, then how do they need to look at real estate? I mean, we talked about a 30-year fixed rate mortgage, but what happens in that environment with property taxes? What happens in that environment with insurance and all these other or maintenance costs?
Right.
And what happens to actually supply? Because as you say, that real estate's really, you're investing in commodities.
Yeah, you are.
So if we go into a big commodity super cycle as a result of the financial repression, how does that impact all of the expenses we talked about, but also future supply coming online?
So the question is, will the increase in commodities prices or house prices, which houses are just a bunch of packaged commodities, right? That copper wire and the concrete and the lumber and the energy
I think
costs.
people forget that.
All that. Yeah. It's all we look around, we see walls and ceilings here, right? In your office. And all of these are built out of commodities that are traded globally and have intrinsic value, separate from any currency. It doesn't matter what the yen's doing, the dollar's doing. The commodities have their own intrinsic value. Every human on earth needs shelter. So that's good. But the question is, do those commodities increase in price, real price, faster than inflation? Right. So the value,
like lumber, in 2020.
Right. And so it went way up. It did come down, but it's still up significantly above where it started before the what do you call it? The medical,
the medicine mandates.
Medicine mandates. Yes. Thank you. And so that's the question. But regardless of that, The mortgage being such a big asset, you know that that mortgage will be debased by that inflation. And that's wonderful. That's what we love. Inflation-induced debt destruction, as I call it. So,
Yeah, that's a good
yeah.
way to describe it. So inflation-induced debt destruction.
It's a mouthful.
Yeah. What usually happens to rents in that type of environment? Like what happened with rents in the 1970s?
Yeah, the rents go up, whether or not they always outpace official inflation, and certainly real inflation. It gets even more questionable because we don't know what the real inflation rate is for sure. But the rents go up, the maintenance costs get higher, property taxes go up, especially as governments become broke and predatory on their citizens, right?
Right.
But the combination of the rents offsetting those costs and certainly the inflation-induced debt destruction benefit of the mortgage, so far, at least historically, investors have won that game hands down. It's been great.
Yeah. One thing I've been trying to figure out is this dynamic we've had over the past few years where housing prices have gone parabolic, but rents have as well. And usually it's you've got that equilibrium mechanism where if rents get too high, then it's cheaper to buy.
Right.
And then if the housing prices get too high, then it's cheaper to rent. So you've got just people going back and forth.
Yeah.
But now we're just seeing both prices go up simultaneously.
Yeah, like crazy.
Have you seen that equilibrium process happen over the past few decades when you've been in this business? Why does it happen? Why is it not happening today?
It's not a perfect thing. I mean, everything you're saying is totally logical, but the other considerations, for one, are not just the cost of the money when you're borrowing to get a mortgage to buy a house. It's also the availability of the money. Meaning, for example, in the last 10 years, the money's been cheap and it's gotten a lot cheaper recently, right? But the underwriting standards have become so strict coming out of the Great Recession that the ability to borrow has been very difficult. I mean, it used to be, George, that if you had a 720 FICO score, you were golden as far as getting a mortgage.
Investor, I think owner occupants are still throwing money at them.
Not as much as they used to, but yes, it's easier for an owner occupant to get a mortgage.
FHA and just all that. If it's guaranteed by the government,
right,
then I think the bank's going to because they're not keeping it on their balance sheet.
Well, neither are the lenders that are selling their loans off to Fannie Mae or Freddie Mac.
That's what I'm saying. Yeah, they're just if they can offload it to Fannie or Freddie, then they're going to do the loan if you got a pulse.
Well, but they have guidelines. Fannie and Freddie have very strict guidelines, and so like I was saying, it used to be 720 was the golden credit score, but now it's 740, 760 on a FICO score, and the way they're underwriting these loans in terms of the debt to income ratios, I mean, it's just much harder to qualify. Now, granted, when you go back before the Great Recession, that all becomes questionable. But leading up to the Great Recession, it was profligate. It was absolutely stupid the way they were. I used to show in my conferences screenshots of emails I would receive that said things like, and I kid you not, from Countrywide. Okay, I got to find these because I got to bring those back. They're from a long time ago. But Countrywide Mortgage, 1 day out of bankruptcy, no problem, get a mortgage. Oh no, I'm not kidding. 580 FICO score and above, get a mortgage. Nothing down, 3% down, 5% down. I mean, no wonder we had a mortgage meltdown. No wonder we had the Great Recession. It was insane. That has not been happening lately. I got to give the banks credit or blame for whatever it's worth, but they have been very strict at underwriting loans comparatively to that.
Yeah, the thing that I focus on are the down payments.
Yep.
So they might be stricter on the lending standards, but the down payments are still incredibly low.
For owner occupants, you're right.
Yeah, yes. I mean, it's still around like 5-6%, very similar to what it was prior to the GFC.
True.
Or if we go back to the 90s and the 80s and the decades that we can remember where we didn't have massive housing bubbles, it was always around 20%.
Well, I mean, you could, as long as you had PMI, private mortgage insurance, you could get 5 or 10% down on
the 90s and 80s.
Oh, sure. On a Fannie Mae, Freddie Mac loan. And on FHA, you could always do 3% down, and on VA, nothing down.
Oh, I didn't know.
But the thing is that's interesting is the loan limits have gotten much higher. Now, granted, so have the prices, but they, if you wanted to get an FHA or a VA loan, now this is for owner occupants we're talking about, you were buying a starter home. But today, a vet can, I mean, I have a buddy who's a vet. And he just bought, following my advice about inflation-induced debt disorder, he bought like a $2 million house with a VA loan. I mean,
Oh, wow.
I
Okay,
couldn't.
okay.
I said, "You can do that," and he said, "Yeah, it's amazing." Yeah.
Okay.
So there are many differences. Yeah.
Yeah. Okay, cool. Let's go over to the chat
We
here.
got a couple super chats.
Oh,
Yeah.
see, now they're showing up on top. That's great.
Yeah.
So is this the only one we have, Josh?
No, scroll. There's more.
Oh, this is it right here.
I saw a couple of them.
No, this is it. Okay. So my fiance got a new job based in Austin. She doesn't have to go in regularly, relocating from the Northeast to Texas. If we can both work remote, better rent in Austin or buy somewhere like Waco. That's a good question.
Oh, yeah, good question. So Austin has become a cyclical market. I just sold one of my properties, my rental properties in Austin, and it heated up quite a bit. I sort of missed the peak on mine, but Austin is still pretty expensive. It's got a lot of Silicon Valley money flowing in there.
Oh, yeah.
So a lot of Northern California, I mean, it's way cheaper than San Francisco for sure. Technically, I'm not addressing the speculative aspect or the appreciation possibility, but you're going to be better off renting in Austin and buying a rental house that you rent to someone else in Waco. And Waco, by the way, is kind of booming right now.
Right.
Yeah.
Okay.
It's a good market.
Yeah, good advice. All right, guys. We'll leave it at that. We appreciate you watching. Enjoy the rest of your afternoon, and I'll see you on the next video.